And welcome once again, options traders, and happy Friday, everyone. A question that I get from a lot of traders is about the leverage of an option. And traders are always saying, is there a way to measure the leverage and trying to figure out ways to use it offensively, or maybe to figure out the risk that you're taking with some short options? And there are a lot of ways to measure an options leverage, but two of the most common, two that you should know about, are called the gearing and the elasticity. Well, let's start with the gearing. It is a measure of an options leverage. And what you're going to do, it's a real simple calculation. You just take the stock's price divided by the options price. So say that the stock is trading for 100 and the $100 call is trading for 2. Just take the 100 stock divided by the $2 call, and we're going to come up with 50. And so what it's really telling you is that for $2, you are controlling 50 times the amount of that value. The problem is, as you're probably already seeing, is we don't really know what that options delta is. We don't know how these relationships are going to change. But still, the gearing can give you an idea of just how much leverage you're dealing with. So to overcome those problems, there's another calculation called the elasticity. And it too is a measure of an options leverage. Elasticity measures are used all the time in finance and in economics. And what you're going to do is to look at the relationships between percentage changes. Now, this elasticity measure is also used in beta weighting. And if you don't know what beta weighting is, there is another video in here talking about that, but you'll see it. That one of the calculations is the elasticity. So what the elasticity does is it shows the magnification of your returns for a 1% change in the stock's price. So the formula is going to be the stock price times the delta, and we're going to divide that by the options price. So notice that the calculations are very similar. We've got stock price here in the numerator divided by the options price. That was the gearing. We're just making a small change. We're going to multiply our stock's price times the delta. And so what we're really doing is saying, equivalently, how many shares are we controlling? See, in the first calculation, it was assuming that you were controlling 100 shares worth. And that's not necessarily true with the option because it depends on the delta. So for those of you good with math, alternatively, you could take the gearing formula, stock price divided by the options price, and then just multiply it by the delta. It's the same thing. So the two formulas are very similar. But what does the elasticity formula show you? So let's say that our stock is at 100 and the delta is a half. And the $100 call is trading for 2. So it's the same example that we saw before, but we're just adding delta to the equation. Take the $100 call price times the 50 delta and divide that by the call's price, which is 2. So now our numerator reduces to 100 times a half, which is 50, and 50 divided by 2 gives us 25. This is the options elasticity, and this is a much more meaningful figure. So how do you use it? Well, what we're saying is that if the stock's price rises 1%, the option should gain 25 times that amount, or 25%. So let's try it. Let's say the stock rises from 100 to 101. That's a 1% increase. But remember, you don't keep that entire dollar. You have a 50 delta. So the option's price is only going to rise 50 cents. And that means your $100 call rises from 2 to 250, which is in fact a 25% increase. All right, so what happens as the option starts going deeper and deeper in the money, getting towards parity? Remember that parity is the condition when the option is trading purely for intrinsic value and no time value or extrinsic value. So let's say that the stock is 110. We're real close to expiration. This call has a delta of 1. And so the $100 call is trading for exactly 10. This would be a parity condition, which means that this call option isn't really even a call. It's stock. That's what it means to be trading at parity. Parity means it's equivalent to stock. So let's go back to the elasticity calculation. We're going to take the $110 stock times the 1 delta, and we're going to divide that by the call's price of 10. So of course that reduces to just 110 divided by 10, which is 11. So now if the stock rises 1%, our call is going to rise 11%. So in this case, the gearing is meaningful, but that's because we know the delta is 1. But you can see how that's going to change. Let's say the stock rises to 120, delta's still 1. The 100 call is trading for 20. What is the elasticity calculation? 120 times a delta of 1 divided by an options price of 20. Now it reduces to 120 divided by 20, which is 6. So what it's telling you is that now if the stock price rises 1%, your option's going to rise 6%. So let's try it here real quick. If the stock rises 1% from 120, that's going to give you 121.20. And that means that this call is going to be trading for 21.20. So if we take 21.20 divided by the old options price of 20, it equals 1.06, which is saying it has increased by 6%. So once again, the only time that the gearing measure is meaningful is if you absolutely know the delta. And that's why most professional traders are going to just automatically turn to the elasticity formula. So remember, any type of calculations that you see like this, especially when they involve the Greeks, delta, gamma, theta, that they're only good for small changes in the stock's price. And that's because as the stock price changes, your delta changes and your options price changes, and that means your elasticity changes. So in our example, we came up with an elasticity of 25. That doesn't mean that every single 1% increase that you're going to gain 25 times that. It's only good, really for the most part, for that next 1% move. But still, it is a very useful tool to help you understand the leverage you've gained from an option, which remember is a benefit for the long options, but could be a very big risk for the shorts. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.